Imagine you're managing a pretty substantial portfolio, right?
Hmm.
And you're hunting for a place to just park some capital.
Right, looking for a safe yield.
Exactly. So you're scanning the usual landscape. You're looking at short-term treasury bills, maybe evaluating some corporate bonds, or scanning high-yield dividend stocks. Now, what if I told you that one of the most mechanically fascinating yield-bearing financial instruments available right now is tied to the literal end of the world?
I mean, it sounds totally absurd on its face.
Okay.
You just don't typically associate eschatology with fixed income asset management. But, it's actually happening right now at scale in the prediction markets.
Yeah, and that's what we're getting into today. We are doing a deep dive into a highly technical, incredibly detailed analysis. It's titled Trading the Apocalypse, Leveraged Analysis of the 2027 Prophecy Market.
It's a fascinating paper.
It really is. And the mission for this deep dive, for you listening, is to unpack the mechanics of how financial traders are deploying leveraged capital to bet on whether Jesus Christ will return before the year 2027. And this is all happening on a decentralized prediction platform called Polymarket.
Yeah, but before we get into the actual plumbing of how all this works, we really need to set a firm boundary for you listening.
Absolutely.
Our discussion today is strictly focused on the market mechanics, human psychology, and the financial behavior.
Yeah.
Because the analysis we're looking at, it naturally references some highly charged real-world events.
Very charged.
Right. It covers Middle Eastern military conflicts. It cites specific theological commentary from prominent evangelical sermons. And we are just reporting these events and viewpoints exactly as they function within the market data.
Yeah, we are definitely not taking sides here.
Exactly. We're not endorsing any theological or geopolitical positions, and we are certainly not trying to predict the end of the world. Our focus is entirely on this bizarre financial ecosystem that just kind of sprung up around the concept.
Right, because the behavior and the math are what make this so compelling to look at. Okay, let's unpack this. Let's look at the actual anatomy of this contract.
Yeah, let's start with the basics.
So Polymarket operates these markets as pure binaries. It is incredibly simple in its structure. The contract resolves definitively on December 31st, 2026 at 11:59 p.m. Eastern Time.
Very specific.
Extremely. And either the second coming occurs and the yes side pays out $1 per share, or it does not occur and the no side pays out $1 per share.
And that binary structure is exactly what creates the opportunity. Because as of the summer of 2026, the market sits heavily skewed.
Like almost totally one-sided.
Right. The yes shares trade at roughly 2 cents, and the no shares trade at 98 cents.
Right.
But the metric that elevates this from just a weird internet novelty to a serious financial case study is the volume.
The sheer amount of money.
Yes. There is $63.8 million traded in this specific market.
And that volume is just staggering when you consider the disparity in how the capital is actually deployed here. Because think about the raw distribution of shares.
It's totally lopsided.
Yeah, it's like a seesaw with a mouse on one end and an elephant on the other. Because if you take $1,000 and you buy the yes side at 2 cents, you walk away holding 50,000 shares.
Right.
But if you put that same $1,000 into the no side at 98 cents, you only acquire about 1,020 shares. So the capital requirement to actually move the no side is massive compared to the yes side.
It's a huge wall of money.
Which really makes me wonder if 98% of the capital is essentially voting that the world is going to keep spinning. Who is funding tens of millions of dollars in volume? Like, are Wall Street algorithms actively trading against religious believers?
Well, the capital flowing into the no side isn't driven by theological skepticism at all. It is driven entirely by the search for yield.
Okay.
Traders are treating the no side of this apocalypse market exactly like a zero-coupon bond.
Okay, wait. I want to make sure we're totally clear on how that functions. Because a bond usually pays you interest, right?
Right.
So how does betting against the end of the world pay interest?
It comes down to the discount on the dollar. If you buy a no contract for 98 cents today, and you hold it until December 31st, 2026, and, the world doesn't end it, Polymarket pays you $1 full.
Got it. So you capture that spread.
Exactly. You capture that 2-cent spread. And that represents a 2.05% gross return on your investment over roughly a 6-month period.
Which isn't terrible, honestly.
Well, earlier in the year when the contract was trading a little bit lower, analysts actually calculated the annualized return at roughly 5.5%. But as we march closer to that December expiration date, That raw return slowly compresses down to the 2% figure.
But still, I mean, a 2% return over 6 months is incredibly boring. A standard 6-month Treasury bill yields about 2.25% for that exact same half-year period.
Yeah, you could just buy a T-bill.
Right. So why would a sophisticated trader take on the platform risk of a crypto prediction market just to uh, basically underperform a U.S. government bond?
Because of leverage. A 2% raw return is definitely boring, but traders don't trade raw returns. Leverage transforms this really mundane yield into a high-octane financial engine.
Okay, here's where it gets really interesting. Let's walk through that math because the transformation here is just wild.
Yeah, let's break it down.
So leverage is essentially borrowing capital to multiply your exposure. If you put down $1,000 of your own money, completely unleveraged at 98 cents, your profit at the end of the year is a tiny 20 bucks.
Barely worth the effort.
Right. But if you apply 5x leverage, your $1,000 acts like a down payment. The platform essentially spots you the rest of the cash, allowing your $1,000 to control $5,000 worth of contracts.
Which completely changes the math.
Exactly. When the market resolves and pays out, you return the borrowed funds, and your profit on that exact same $1,000 down payment jumps to $102.
And just like that, you've suddenly engineered a 10% return over 6 months, which is a 20% annualized yield.
That's massive.
It is. You're vastly outperforming traditional fixed income markets. And the only requirement for you to collect that 20% yield is that humanity literally just survives the year.
It sounds like an infinite money glitch. I mean, you borrow money, you bet on the sun rising tomorrow, and you collect a 20% yield. But there has to be a massive catch here, right?
Oh, there always is.
Yeah, in finance, if you're getting a 20% yield on something that seems like a total certainty, you are usually taking on a hidden catastrophic risk.
And you are. The hidden risk here is the structural integrity of your leverage.
How so?
Well, when you use 5x leverage, you don't own those contracts outright. You are heavily in debt to hold them. Your $1,000 down payment is just your equity cushion.
Okay, tracking with you.
So if the price of the no contract suddenly drops from 98 cents down to, say, 94 cents, your underlying asset has only lost 4% of its value.
Which doesn't sound like a lot.
It doesn't. But because your position is magnified 5 times, that 4% drop actually wipes out 20% of your actual equity.
Wow.
And if the price drops far enough, your equity cushion evaporates entirely. The platform's algorithm steps in, it issues a margin call, and it automatically liquidates your entire position just to pay back the lender. You lose everything.
This sounds exactly like picking up pennies in front of a steamroller. It's like buying a house with a tiny 3% down payment.
Exactly.
If the property value drops by 4%, your entire ownership stake is wiped out and the bank seizes the house. But what I don't get is, why would the no contract ever drop? Why would the probability of the world ending suddenly surge?
Right, because the real world isn't ending. But to understand that, we have to look at the absolute chaos that erupted in this specific market in February of 2026.
Oh, the February spike. I was looking at the charts from the source, and the yes side suddenly rockets from 1.8 cents up to a peak of 4.7 cents.
It was a huge move.
But there were no trumpets in the sky. The world didn't end.
No, the real world was completely quiet. That price spike was driven entirely by financial engineering.
Okay, explain that.
Well, some enterprising traders had created a secondary derivative market on Polymarket. This new market was basically a side wager, specifically betting on whether the main apocalypse market would cross the 5% threshold during a really narrow 1-hour window on February 17th.
This is like the movie Inception. It's a bet inside a bet. So they aren't even betting on the event itself anymore. They're just betting on the price movement of the event.
Exactly. And that secondary market creates a completely perverse coordination incentive.
Because they can manipulate it.
Right. If you stand to make an absolute fortune on the side wager by guessing the main market will hit 5%, it suddenly becomes mathematically rational for you to spend your own money to force the main market up to 5%.
So you manipulate the primary market to trigger the payout on the derivative. That is wild.
It really is.
Let's look at how they actually executed that, because it requires drawing up the order book. If you want to force the price from 1.8 cents to 4.7 cents, you essentially have to buy up every single sell order at 2 cents and then sweep up all the orders at 3 cents.
It's just clearing it out.
Yeah, and you keep buying until the only people willing to sell are asking for 4.7 cents.
Yeah.
You engineer a total liquidity squeeze.
And, to make matters crazier, It was exacerbated by a technical error on the platform itself.
Wait, really?
Yeah. Polymarket had just rolled out this confusing new interface,
Yeah.
and their automated systems accidentally allocated $35,000 in liquidity rewards specifically to this apocalypse market.
You've got to be kidding me.
So right as these traders are executing a coordinated squeeze, the platform is actively subsidizing the artificial volume.
So they're getting paid to manipulate it. The payout for the traders running the squeeze must have been astronomical.
Oh, it was.
Because if you bought into the yes momentum early at 1.8 cents and sold near the top at 4.7 cents, you captured a 161% gain on the underlying asset.
Which is great on its own.
Right, but if you executed that trade using 5x leverage, you turned a $1,000 margin into an $8,056 profit. You are pulling an 800% return out of thin air in a matter of hours.
It is brilliant predatory trading. But you have to consider the collateral damage here.
The steamroller.
Exactly. Go back to those no traders we discussed earlier, the ones treating this market like a boring treasury bill, passively collecting their 20% annualized yield.
The ones who bought the house with a tiny down payment.
Yes. When the yes side spiked to 4.7 cents, the no side mathematically plummeted to 95.3 cents.
Right, because it always has to equal $1.
Exactly. So if you were holding a 5x leveraged no position, that sudden artificial dip chewed through your equity cushion instantly. The platform's algorithm triggered margin calls across the board. Passive yield farmers were forcibly liquidated.
That is just the ultimate irony of this market. Those no traders were fundamentally right. The world did not end on February 17th. Their read on reality was 100% accurate, but the financial engineering wiped them out anyway.
I didn't care if you're right.
No. It proves that being right about the outcome doesn't matter at all if your capital structure can't survive the volatility along the way.
It really highlights the danger of heavily collateralized systems. But you have to remember, the February spike was entirely synthetic. It was just traders playing games with order books. The analysis becomes even more fascinating when we look at how this market reacts to genuine, real-world exogenous shocks.
Right, because 2026 has not been a quiet year. In late February and early March, we saw a severe military escalation between Iran and Israel.
We did.
And the source we're reviewing details how heavily this resonated within the evangelical community. Prominent commentators immediately framed these military strikes as prophetic fulfillment.
They were very vocal about it.
Yeah, there was a specific March 1st sermon by John Hagee titled God's Coming Operation Epic Fury. The data also tracks commentary from figures like Lance Wallnau and Greg Laurie, and they were all actively connecting this regional conflict directly to end times theology.
So you have major media figures with massive audiences stating that a current geopolitical crisis is the actual catalyst for the events this market is built around.
Right.
Logically, you would expect an influx of believers to flood the yes side, driving the price up, just like the squeeze in February.
But hold on, I'm struggling to reconcile the data here. You're telling me a technical glitch and a few day traders messing with the derivative can spike the market up to 4.7 cents, triggering mass liquidations.
Yes.
But a literal regional war, accompanied by massive, widely broadcast sermons declaring the end of days, doesn't move the needle. How is that possible?
Well, what's fascinating here is that the 98% wall on the no side represents a hardened financial consensus. During the Iran-Israel escalation, the no price held absolutely firm at 98 cents. It didn't budge a fraction of a penny.
I'm sorry, hold on. The market just ignored the news entirely.
It completely ignored it because the market differentiated between the types of threats.
Okay, how so?
In February, the threat was structural. A coordinated squeeze threatens the mechanics of the order book itself. Real-world geopolitical news, however, requires organic capital to flow in and shift the consensus.
Ah, I see.
And traders learned from the February liquidations. They realized that organic retail capital, even when it's driven by fervent theological belief, simply doesn't have the sheer mass required to chew through the tens of millions of dollars sitting on the no side.
They realize the believers aren't bringing enough leverage to break the bank.
Precisely. And this realization caused a massive shift in how professional capital navigates this market. They stopped fearing the news cycle. They started categorizing real-world escalations as tactical positioning windows.
So they changed their whole playbook.
They did.
And the analysis actually breaks this evolution down into 3 distinct strategies that traders are currently deploying for the rest of the year. There's momentum, yield, and fade. Let's look at how these actually work in practice.
Sure.
If you are playing the momentum strategy, you are operating on the yes side, right?
You are. But crucially, you aren't betting on the apocalypse. You are scanning the news flows and looking for the next derivative side bet.
So you're just looking for the next artificial pump.
Exactly. When a geopolitical flare-up happens, the momentum trader buys in early, not because they think the world is ending, but because they anticipate a temporary panic. They ride the psychological wave, and then they sell their position back to the market before the price inevitably reverts back to 2 cents.
They're essentially surfing the panic. Okay, so the second strategy is yield, which is the no side we've been talking about. But you mentioned they learned from the February liquidations. So how did their behavior change?
They adopted a highly defensive posture. They still want that leveraged return, but they respect the volatility now.
They don't want to get steamrolled.
Right. So during periods of high geopolitical tension, these yield traders actively deleverage. Instead of running at 5x leverage and risking a margin call, they dial it back down to 3x.
Okay, so they give up some profit for safety.
Yes. They willingly accept a lower return, maybe 12% annualized instead of 20%, in exchange for a much thicker equity cushion. They ensure they can survive a sudden artificial price spike without getting liquidated.
Survive the turbulence, collect the check in December. Makes total sense. Now, the third strategy is honestly my favorite because it's so incredibly opportunistic. It's called the fade.
It's very clever.
It's a hybrid approach. The fade trader just sits on the sidelines in cash. They literally wait for a manufactured event, like the February squeeze, to push the yes side up to 4.7 cents.
Right, they wait for the distortion.
Yeah, and when that happens, the no side naturally drops to 95.3 cents. The fade trader swoops in, buys the no side at a deep discount, and captures the profit as the panic subsides and the price reverts back to 98 cents. Plus, they get the final 2% resolution yield when the contract expires.
It's a brilliant arbitrage of human panic. But, to execute any of these strategies with leverage, traders run into a massive structural wall.
Right.
Because Polymarket, the actual prediction platform hosting this contract, operates on a fully collateralized basis. They do not natively offer margin lending.
Which completely kills the 20% yield strategy for anyone who doesn't just have millions of dollars sitting around in liquid cash. You literally can't execute a 5x leverage trade on their platform alone. So what does this all mean? How are these traders actually getting these multiplied returns? Where is the borrowed money coming from?
Well, this is where the decentralized finance ecosystem gets incredibly complex. Because Polymarket doesn't offer leverage natively, a secondary prime brokerage platform emerged to fill the vacuum. The analysis points us to a platform called Predmart.
Okay, so Predmart acts as the shadow banking layer. Let's break down the plumbing of how they do this, because if I want 5x leverage, I don't go to Polymarket.
No, you go to Predmart.
I go to Predmart, I give them my $1,000 down payment.
Yeah.
Predmart takes my money, combines it with $4,000 from their own liquidity pools, and they go execute the trade on Polymarket.
Exactly. Predmart holds the underlying asset, and they hold the liquidation power over your account. They're essentially recreating the traditional prime brokerage model used by Wall Street hedge funds, but they're applying it to decentralized prediction markets.
But that introduces a whole new layer of danger. Now, I'm not just betting on whether the world ends. I'm betting that the Polymarket smart contracts don't get hacked, and I'm betting that Predmart remains solvent enough to return my collateral in December.
It's a lot of risk.
I am layering counterparty risk on top of platform risk, all just to squeeze a 20% yield out of an apocalypse bet.
Well, financial markets abhor a vacuum. If there's a yield to be amplified, a secondary platform will always emerge to provide the leverage, regardless of how bizarre the underlying asset actually is.
We have covered an immense amount of ground today. We started by looking at how sophisticated capital treats the literal end of the world as a mundane, zero-coupon bond. We walked through the brutal mathematics of margin calls and how a 5x multiplier can turn a 2% certainty into either a massive payday or a total liquidation.
A steamroller.
Yeah, a steamroller. We examined the chaotic plumbing of platforms like Predmart engineering leverage out of thin air. And perhaps most surprisingly, we looked at how traders view real-world military conflicts and heavy theological narratives not as signs of the times, but simply as temporary pricing inefficiencies to be arbitraged. It is truly a masterclass in risk management and human psychology.
It really forces us to reevaluate the purpose of the tools we use to measure reality. Because the evidence we've unpacked today leaves us with a fascinating paradox.
How so?
Well, if a purely synthetic financial derivative like a side bet, on a 5% price target can trigger a massive liquidity squeeze and wipe out leveraged traders, while a literal regional war tied to prominent prophecy doesn't move the market a single cent. What does that reveal about modern financial architecture?
That's a profound point.
Have our instruments of financial engineering become so complex and so self-referential that they now command more influence over the market than the actual physical realities that were originally built to track?
That is a question you can apply to almost any market trading today. Are we actually trading real-world events, or are we just trading the financial derivatives of those events? It is definitely something for you to think about the next time you look at a ticker symbol.
Thank you for joining us on this deep dive. We'll catch you on the next one.